Hello friends, now I'm glad to welcome you all to our channel. So now we are going to see about what is capital gains. So do you know what is capital gains? I'm giving one example. Mrs. Nohara has brought a share for 1 lakh and she and after 2 months she sells the share for rupees 1,20,000. So she brought for 1 lakh, but now she sold for 1,20,000 to Mitsubam. So 20 percentage is 20,000 is her profit. So that the 20 percentage is called capital gain. For the 20,000 we going to charge a tax. So simply the capital gain is a profit we gained by selling an asset is called a capital gain. So the assets may be the assets such as stocks, bonds, real estates, buildings, etc, etc, etc. So the and also a jewelry. Now we're going to see about types of assets, capital assets. There are two types of capital assets. They are short term capital assets and long term capital assets. Short term capital assets, the assets hold for less than 36 months is called short term capital assets. For long term capital assets, the asset we hold for more than 36 months is called long term capital assets. So I'm explaining a tabular column on short term and long term assets. So immovable assets, example real estate, the duration is less than 2 years. Immovable assets, if you holding real estate, land is a business of real estate. If you holding a land for period not exceeded 2 years means it is said to be short term capital assets. But if you hold for the asset for more than 2 years means it is said to be long term. And movable property, gold, if you brought gold and if you sold it before 3 years means it is said to be short term capital assets. And if you hold the assets for more than 3 years means it is said to be long term. And listed shares you hold less than 1 years means it is said to be short term. And if you hold for more than 1 year means it is said to be long term. And equity oriented mutual funds, asset you hold for less than 2 years means it is said to be short term. And if you hold more than equity oriented mutual funds, if you hold less than 1 year means it is short term. If you hold more than 1 year means it is long term. For debt oriented mutual funds, if you hold less than 3 years means it is said to be short term. And if you hold more than 3 years means it is said to be long term. And do you know what is the difference between equity oriented mutual funds and debt oriented mutual funds? Equity oriented mutual funds means simply we are investing in shares and bonds and other securities. We are investing in share markets and bonds, the government bonds and public bonds, do you know, and other securities. Yeah. And debt oriented mutual funds means you are investing in government debts and corporate debts. Do you know government debts? Government are borrowing a loan and developing for the infrastructure projects. If you investing it, it is said to be debt oriented mutual funds. And now we are going to discussing about the format of short-term capital gain. Do you know the format of the capital gains? Full value of consideration. The full value of consideration is the asset you sold for the current year and less expenses on transfer. If you if you paid any expenses, if you had any expenses on transfer, for transfer means transferring of an asset. If you are having a share, do you need to sell to other person, other investor? So do you need a center for connecting you and for connecting you, a seller and buyer? That need a broker. So do the broker connects buyer and seller. So in such case, you are selling a share to the buyer. The middleman broker has had helped you to identify the buyer. So in such case, broker helped you and you need to pay expenses for the broker. So it is called as expenses on transfer. Do you know? Yeah. It has many examples such as transport and everything, etc. And if the full value of consideration and the expenses on transfer you subtracted, you will get net consideration. From that you need to less cost of acquisition. Do you know cost of acquisition? The cost of acquisition is simply I'm giving some examples. Your father your father has brought an house for 50,000 in 1991, and for 50,000 he brought an asset for 1991, and the price value of the asset is on 2006 to 2007 is 4,40,000. Means the cost of acquisition is we need to assume the buying price and this value on the 2006 to 2007, that period. By assessing this period, we need to take the which is greater. So the dad has brought before 1991, so he only brought first, so that amount only is cost of acquisition. Means it is wrong. The cost of acquisition is the which is greater, among from which is greater is cost of acquisition. Cost of improvement means, do you need to sell this house for house on you sold your father's house on 2010. So for selling the house in 2009, you you redesign the house by painting, wall painting, and adding gates, and having a flower pots, and gardened the beautiful flowers for these, and the satellite, the antenna for that, all all facilities for solding a house, for developing it. You held rupees 50,000 for improving the house. So the improvement in house, you had a cost of rupees 50,000. So this cost of acquisition amount and cost of improvement you detected, and you will get one answer. And among from that net consideration, do you need to subtract, and do you get, and you will get the long short term capital gain. So we got short term capital gain, and long term capital gain is also that, like the full value of consideration. Yeah, property you sold for the current year, and less expenses on transfer. Expenses of transfer means do you know the brokerage amount and the transactions amount. You reject this full value of consideration and less expenses on transfer. You will get a net consideration. From that, do you need to less indexed cost of acquisition? Do you know the what is the indexed cost of acquisition? Do you from the cost of acquisition, do you need to multiply the that inflation cost acquisition, inflation cost you need to into multiply inflation cost, the IEC, uh, it will given on your question. From that, you need to take the correct period and the greater amount at the numerator and smaller number as the denominator. You need to multiply with the indexed cost of acquisition. You will get the answer. And indexed cost of improvement, the same improvement into that initial that sorry inflation cost. The you need to multiply the in inflation cost and you will get the one's total answer. You will get the answer. From that, you need to less indexed cost of acquisition, indexed cost of improvement. You will you detect this and you will get the answer. From that, you need to from net consideration, you need to deduct this cost and you will get the long term capital gain. Yes. And for investing in shares, the tax rate is less in this capital gain. So capital gain, so only many business peoples have been becoming richer by this way of capital gains. So this was our video about capital gains. I think you gained some knowledge about it. So if any queries or doubts, comment. Yeah, yeah, give a thumbs up, share, comment, subscribe,